Hello, everybody. Happy Thursday to you all. Thank you for joining us today on this impromptu webinar that we are going to be doing. Yeah, we are testing out a brand new streaming software that we want to really test out and get. So we would love to know if things are working. But I am here with my business partner, Mr. Brian Withers. Well, thanks for joining me, Brian.
Hey.
And today we are talking about the Rule of 40. We hope that this is a topic that you already know a little bit about, but if you don't, I think you're in for a quick treat today. So what is the goal of this short webinar? It is I will be able to, by the end of this webinar, we're hoping that you can be able to calculate a company's Rule of 40 score and understand why this number matters. So what is the Rule of 40? That's what we are going to explain here. If you've ever seen us share this visual before, this is the 6 stages of a company's business growth cycle. We think there are 6 distinct stages that a company goes through during its life as a company, and it's important to know which stage a company is in so that you can value it and judge it by the appropriate metrics. Now, the hardest stages to judge a company's progress are these stages here, phases 2 and phases 3. It's very difficult to value companies that are in these stages, and it's really hard to figure out how a company is doing. Oftentimes, companies that are in these stages are losing money. They are not profitable. So we want to be able to tell, are these companies doing the right thing so that they can gradually progress along the business growth cycle. Now, companies in this stage are trying to balance 2 competing forces against each other. And those forces are, on the one hand, trying to grow the revenue as quickly as possible by reinvesting in the business. And on the other hand, the company is trying to balance out profitability. And this is a direct trade-off that companies have. If a company can focus solely on growth, and growth is what many investors want to see in the early stages of business development. Other companies or other managers and investors want to see a company focused on profitability. And balancing these 2 factors can be a huge challenge for companies. So what happens if you over-index on growth? Well, that's great because growth is really good and important in the early stages, but that comes with a risk. If you're growing very quickly and not paying attention to profitability at all, you're very reliant on the capital markets. You need outside funding to keep the business going, and this could set you up where you could be facing potential bankruptcy down the road. On the flip side, if you focus all of your effort on profitability or generating profits during this time, you may not be investing aggressively enough to take advantage of opportunities. You might not be building out the moat that you need that will eventually lead to more profits in the future. You're not investing enough in the business. So balancing these 2 objectives, growth and profitability, is a tricky thing for all companies to do. So the one way that we can tell how well a company is balancing these 2 dynamics, growth and profitability, is by using this rule of thumb, which is called the Rule of 40. So what is the Rule of 40? It's simply when you sum up a company's revenue growth rate and one of its profit margins. And the goal is for this number, that quick sum, the revenue growth rate and the profit margin, to be over the number 40. If a company is doing that, then you know it is succeeding at balancing its revenue growth rate with its profit objectives. So the 2 numbers you need to know are growth rate, and that is almost always, in fact, always revenue growth. But how do you measure profitability? The unsatisfying answer there is that there are lots of ways to measure profitability. It could be the free cash flow margin. It could be the net profit margin, the operating profit margin. It could be EBITDA, adjusted EBITDA, or even the NOPAT margin. So which profitability metric you're focused on often changes depending on the business that you're looking at. But for the sake of this talk and this presentation, we're going to focus on our favorite profit metric, which is the free cash flow margin. Free cash flow margin. Now, as a general statement, when using the rule of 40, a higher number is good and a lower number is bad. And 40 is the benchmark that we want companies to be above. Above 40, good. Below 40, bad. And the higher, the better. So the math here is very easy. It's the revenue growth rate over the last year plus the free cash flow margin. We want that number to be over 40. So let's see a really simple example here. Company A has a revenue growth rate of 15%, and it has a free cash flow margin of 40%. What is its rule of 40 number? 15% plus 40% equals 55. That number is well above 40. That is a good number. Next is company B. This company is growing its revenue faster, 20% per year, but it has a 20% free cash flow margin, slightly slower. And the company here has a rule of 40 of 40. So it's right on that rule of 40 number. Company C is growing the fastest. 100% is the company's year-over-year growth rate. Very, very fast revenue growth. But to achieve that, it has a free cash flow margin of negative 80%. So 100% minus 80% is 20. Of all the companies here, we would actually say that company A, despite growing the slowest, has the best balance of profitability and growth when measured by using the rule of 40 benchmark.
So Brian, the kind of go back to that slide there, you missed a couple percentages, but like it's not really adding these are percentages, but we use them
Correct.
as whole numbers, right?
Correct.
It's a little bit confusing there.
Yeah, that is true. Thanks for pointing that out. So let's see a real world example. SentinelOne. This is a publicly traded company. It's been on the market for a couple of years. SentinelOne competes against CrowdStrike in the cybersecurity market. Now, when SentinelOne came public, it was definitely in the phase 2 of its growth cycle. It was trying to balance revenue growth and profitability. So if we go over to fiscal.ai and we click on the financials button and we click on the income statement button, and then we set the results to annual, what we're going to take a look at is the company's revenue growth rate on these multiple year periods. And all we're going to do is we're going to take these numbers here and we're going to put them into this table here to make this number easy to visualize. So in 2022, its revenue growth rate was 120%, then 106, 47, and 32%. Next, we're going to take a look at the company's free cash flow margin. So we click on financials and then annual and then ratios. Click down to margins, and we're going to look for free cash flow margin, which are listed right here. We're going to put these in, and there the free cash flow margins are put out. Now we're just going to do that very simple math, adding the revenue growth rate to the free cash flow margin or subtracting it in some cases. And here's what we see when it comes to these numbers. So back 3 years ago, SentinelOne had a rule of 40 of 71. So even though it was losing 50, had a negative free cash flow margin of 49%, that was okay with investors because that was resulting in fast enough revenue growth to make the rule of 40 a strongly positive figure. 2 years ago, that number dipped to 59 on a rule of 40. And again, the company was losing gobs of money, but it was growing its revenue fast enough to justify it. So the company was successfully balancing growth and profitability. 1 year ago, the company's revenue growth rate fell to 47%, but its free cash flow margin improved quite substantially to negative 11%. So while the profitability of the company improved substantially for year over year, this number actually dipped to 36. And then the following year, it was actually producing positive free cash flow margin of 4%, but revenue growth fell to 32, giving it a 36% number. So we can do this kind of analysis to figure out if a company is losing money and that lost money is resulting in fast enough revenue growth to justify continued investment. Now, one really cool thing I want to show you guys here is that we can actually have fiscal.ai do this math for us so we can judge this. If you're watching and you want us to do this analysis on a specific company, please just throw in the chat what company, or put whatever platform you're watching this in. Leave a comment saying which company you want us to do this analysis on, and I'm happy to do that analysis, but I'm going to show you how to do that now. And let's do a very popular company that is, for years, was losing money and recently went through this process. Let's go with Palantir, ticker symbol PLTR. So here we have Palantir loaded into fiscal.ai. And I'm actually going to click on financials right here. And I actually put the metric in there. Let me close that out and show you how I did that. So over here on the right, I'm going to click on custom metrics. And here is the custom metric that I made. And I'm actually going to, let me go with add a custom metric, just so I can show you how I kind of made that. So we click add a custom metric. And it says format, and I want the format to be percentage. Then I'm going to give this new metric a name, and I'm going to call it rule of 40 number, just so that's a little bit different. And then using this magic formula builder, we can actually build this metric out. So the first thing we need is revenue growth rate. So if I search for revenue and then 1 year revenue growth rate, I choose that number right there. Now, Fiscal puts it into this little math formula down here. So we have the revenue growth rate, and I'm just going to click the plus button. So we want to take the revenue growth rate, and then we want to add to that. Let's just go with free cash flow margin. Free cash flow margin right there. So revenue growth rate plus free cash flow margin is our rule of 40 number. We're going to add this metric and turn this one off, and then we're going to turn that one on. And here is Palantir's rule of 40 since it came public. Now,
that's really cool.
Yeah. What jumps out to me, Withers, is that this number in 2016 looked really poor, 9. But the company has actually substantially improved its rule of 40.
And it's getting better too. Look at that.
Here since it came public. That is unbelievably hard to do. Most companies do the exact opposite, like we saw with Sentinel-1, where this number got worse over time. With Palantir, this number actually got better as time went on. I think this is one reason, not the only, but one reason why investors have been so enthralled with this company's performance since 2022, because the revenue growth rate plus the free cash flow rate is resulting in a rule of 40 of 82 recently, which is just an unbelievably impressive number. Remember, the gold standard here is 40. This company is almost double that, which is just amazing.
And 40, I mean, is there anything magic about 40?
The magic thing is it's the number that Silicon Valley venture capitalists came up with.
There you go.
So it is a good benchmark. It is a good way of saying, again, it's a benchmark for judging, are they balancing risk and profit, growth rate and profitability? So that's all that it is.
Awesome.
Now,
well, we have a few suggestions for stocks. You up for one?
Yeah, let's do it.
Yeah, we got Paul Quinn.
Paul Quinn, okay.
From Twitter. I can't call it X. Twitter, who wanted us to do Transmedics.
Transmedics. Yeah. Okay, so here we have Transmedics. Yep, this is a good company to do this on. It's a high growth company. So I wonder if I can add existing metric.
Yeah, and really the first thing before you do any of this is kind of verify that it's in that phase 2 stage.
Well, it can be used on different stages, but it's most useful in stage 2. So from an operating perspective, this company is profitable. It is profitable, and its operating margin has improved dramatically. That's one way of figuring out which stage it's in. Another one would be to look at its free cash flow margin, which is in ratios, and then margins, and then free cash flow margin. So this is a company that's dramatically improved its free cash flow margin, 21% free cash flow margin recently. But anyway, let's do the analysis on it. So custom metrics, add custom metrics, percentage, rule of 40.
You have to add that every time? That's annoying. Oh, okay. You just type in the metric name, or
yeah, I think there is a way to, I think, bring it over, but I'm showing people how to do it.
Okay.
Yeah, revenue growth 1 rate, and then we do add metrics. So there it is. So here's what we see. So this is, again, judging the company's ability to balance revenue growth. So back in the early 2000s or early 2020s, this number was quite poor. COVID was in there, so I'm not going to fully knock the company. But in 2022, this company had a rule of 40 number of 147. And while this number has come down, even today, this number is almost 50. Almost 50. So Transmedics is doing a fabulous job on a rule of 40 basis. That doesn't guarantee to translate into stock market performance. There are plenty of other factors in there. But when asking the question, is management doing a good job here of balancing profitability and revenue growth? To me, unequivocally, the answer is yes.
So I wanted to throw this comment up because I really like it. And when we were looking at Palantir, this kind of applies as well, right?
Yep. So the rule of 40 led me to Duolingo and Zeta Global. App 11 is also quite good, but you have to look at valuation, and it's expensive. Absolutely. This is not just, is the company balancing, is the company a good buy or not? The question that the rule of 40 answers is the management team doing a good job of balancing revenue growth with profitability and managing itself? And this is, again, a shortcut for doing just that. Do we have any other stocks you want to check out?
Oh, absolutely. We have our choice here. Why don't we go with Zeta?
Zeta or Zeta? Not sure how to say that.
Omar on YouTube. I love that we have folks from all the different platforms on today.
Yeah, very cool. Very cool to see. So add an existing metric. I wonder if I type in rule of 40.
Yeah, I wonder. I'm sure there's a way to add it that you can grab it every time.
Oh, right here. Duh. Apply metric to all companies.
There we are.
There you go. That's why I did it wrong. Okay, rule of 40. And then we'll do, but it's good to show people cash flow margin.
Yeah, just how to set it up, because it's a little intimidating, but once you do it the first time, there you go. Awesome.
So here we have Zeta. I don't know what Zeta does. Let's see.
Well, you can just go over the overview.
I can, but I'll keep this up for now. So Zeta, it looks like 2024. So right now, Zeta's revenue rule of 40 is 35%. And this is annual, by the way. We should be able to look at it quarterly as well to get an even more granulated book. We do quarterly. Yeah. So here.
Yeah, I especially like to look at, especially these high growth companies in their early stages. Looking at it quarterly, to me, makes the most sense. Right?
Totally. So we can see that this number does bounce around. The lowest it's been over the last 3 years is 30. Even right now, it is 40. Wall Street loves it when this number is rising and dislikes it when it's falling, as it does with pretty much any number. That's good. But I would say that the company is actually doing a good job of exceeding its of balancing risk and profitability. Yeah. What does this company do? Omni-channel data-driven cloud platform that provides enterprises with consumer intelligence and marketing automation software. It's a $4 billion company. That's a new one to me. Cool.
Yeah. So we got. Why don't we do a couple more, and then we'll wrap up if there's no other questions. IREN, IREN for Market Beta.
IREN. This has been a very popular company.
It
recently. I can't imagine why. Let's see. Earlier this year, it was $5 and now it's 45. So it's been a 9-bagger this year. This is a company that mines Bitcoin and it's trying to get into the
Data center
running
space, right?
data center, right? Yeah.
Yeah.
Electrical and data center infrastructure, like outsourcing computing. So let's see. If I go to custom metrics,
And then you should just be able to, oh, look at that. There it
there
shows
it
up.
is. Rule of 40.
Woo!
So this number was 20,000. I have a feeling that's when it went from no
Yeah, I
revenue
was
to
gonna
some
say,
revenue.
if you shorten up the time frame and make
Yeah.
it quarterly, it'll
Yeah.
be
So if we go
better.
quarterly and then we view it on a more granulated look, 297. So I have a feeling that this company is rapidly growing its revenue, but this number is all over the map. This number is all over the map. And if we look at revenue growth,
Especially with free cash flow, if it's investing in data centers ahead of demand,
yeah.
yeah, you're gonna see capital expenses there.
Now they got me curious. Is this company producing free cash flow? No. Negative, positive, hugely negative,
Wow, that's
hugely
a real
positive.
big negative.
Yeah.
Shoo.
Yeah. So this number is kind of all over the map. But yeah. Given where this company is in its growth rate, the rule of 40 might not be the best way to judge this company right now, but this number is all over the map. It's a good one. Withers, trying to think of companies that recently became profitable, like Uber. Uber is probably a good one to look at financials. And now that it's saved as a custom metric, let's take a look at Uber's rule of 40. This number's 30. In 2022, it was as high as 83, dipped negative during COVID. You get a free pass on that one. And if we look on a quarterly basis, this company is consistently hovering around the mid to low 30s. And again, if this number is going up, that's very good. If it's holding steady, that's perfectly acceptable. It's really the huge declines that you want to be kind of wary of. But if we match this up with the company's stock performance, I would guess it matches pretty closely with bottoming in 2023 and then growing from there.
Yeah. Got one from Lion Roar Technology, wanted us to do open AI, but they're not a public company, right?
Yeah, exactly. We would love to do. I would love to do it on OpenAI, but they're not a publicly traded company, so not one that we can do it on.
Yep. Got a couple questions if you want to.
Yeah, Market Beta here says, how do you guys go about valuation for growth stocks? Because most of them do not have any free cash flow. So again, you don't need free cash flow for the rule of 40 to work. Since it's using the free cash flow margin, it's measuring the relationship between free cash flow and revenue on a percentage basis. So this is why even companies without free cash flow, negative free cash flow, you still can do the rule of 40 analysis on. Again, it's not purely a valuation number. It's a way of judging management to say, are they balancing growth and profitability appropriately? Are they doing a good job with that? So that's what it is. But the question is, how do you go about valuing growth stocks? So getting back, I'll pull up the slide on there. Let me see if I can go back to basically the early one. This visual here, I think, is so important for figuring out. Oops, wrong one. This visual here is something you just need to drill into your brain because the method that you use to analyze a growth company totally depends on which phase of the business growth cycle it's in. When you say growth company, I'm broadly going to say that could mean, well, is it a startup? Is it a company that's in the self-funding phase? Is it a company that's in the operating leverage phase? Because knowing which phase it's in will have an impact on how you value that company. You can't value a startup the same way that you value a company that's in the operating leverage phase, even though they're both quote unquote growth companies. So the earlier the company is in its journey, the more you have to use extremely imprecise valuation techniques like total addressable market analysis or price to sales analysis. And the later the company is in its growth phase, the more you can get more advanced tools like reverse discounted cash flow analysis, price to earnings analysis, DCF analysis, stuff like that.
Yusuf, thank you. We appreciate your comments.
Yeah, there you go.
So we have a couple more if you want to.
Sure. Yeah.
Let's see. Oh, so NICE, NICE.
Nice.
Magical Self. Love the handle there.
Is this them? Nice.
Yeah.
Cloud platforms for AI-driven
I'm guessing that's it.
Yep. So this company is software company founded a long time ago. $21 billion market cap. It's got a PE of 12. And it also has it also has a, let's see, no dividend, but I'm guessing, just looking at these numbers quickly, it has an operating margin of 21%. And I'm guessing that this is going to be a company that's in phase 5 of the business growth cycle. I'm guessing that's in capital return phase without knowing too much about the company. So this is not the best company to do this analysis on, but since we're here, I'm happy to do it. Again, the rule of 40 analysis is best on companies that are in stages 2 through 2 and 3. It doesn't work as well on phase 1. It doesn't work as well. I say even 2, 3, and 4. It doesn't work as well on phase 5. But since we're here, let's push the button and find it out. So looks pretty good.
Yeah.
Let's see. The most recent quarter, 31%. This company was consistently above 30. So doing a pretty good job of balancing the
two. Somebody was asking about Fiserv, and I think it's a similar situation. Fiserv, I'm pretty sure, is in stage 4 or 5.
I think that they. Yeah. Oh my gosh, what a chart.
Yeah. Recently it's been
230 down to 60. Yikes. This is a historically been a very strong business. But hey, it now that the metric is loaded and we don't have to do the math, it's very easy to look up. Oh, didn't load that for some reason. I have to do it again. Percentage. Rule of 40. Free cash flow margin. Come on.
Oh no.
Okay, that's not working right now. Free cash flow.
And so the other thing you can do with the rule of 40 is use it as a screener, right?
Yes. I don't know why
I think that's probably the most useful piece of it is you're looking at some of these companies and you want to compare one against another.
Well,
wow.
Fiscal ain't loving it on this one for some reason. I don't know why. Yep. But this is a company that's clearly in stage 5 to me.
Yeah.
So if I was gonna judge this company valuation, God, is that true? It's got a PE of 9 and a forward PE of 8.
Yeah. That's because I think the market, like when they see bad news, overcorrects to the downside, and when they say good news, it overcorrects to the upside.
Yeah, this is a good example of the market is quote unquote perfectly efficient being complete bunk. Because in the same year, this company is going to be worth, I think we can do this company, like what's the market cap? Market cap now is 32 billion and the market cap was 150
4
billion.
Times that?
Yeah.
Wow. That's insane. Let's do one more. I don't know if the fiscal will cooperate with us, but I like Reddit. Reddit's a
Reddit. That's a good one.
Yeah. Thanks, Jeremy, for requesting that one.
There it is. Yeah. Wasn't working on. Yeah. Reddit. Great company to do it on because they recently became public. Rule of 40, 99. And look at the growth in this number here. So not only has this company become more profitable, its growth rate has increased. Yeah. So again, Wall Street loves this. Loves when this number is going up because that means the company is really doing a good job of balancing profitability and growth all in one go, which is very impressive to see. Very, very, very impressive to see. I think Reddit stock has been doing quite well since it came public.
Yeah, it's bounced around a little bit, but yeah.
Yeah, well, it's just about triple.
Certainly if you bought it way back then, you'd be in really good shape.
Yep, for sure.
So we want to wrap up?
Yep, for sure. Well, thank you guys for joining us. Let me get over here. Is this working? There we go. Thank you guys for joining us. We hope that this quick mini lesson was useful. We do plan on going live on all social platforms every Tuesday at 12 o'clock. And next Tuesday at 12 o'clock, we are going to be doing an hour-long deep dive into the #1 most requested stock that we've gotten over the last 2 weeks, and that's Mercado Libre. So if you ever want to learn more about Mercado Libre, its business, its moat, its growth potential, management team, and more, tune in, same time, same platform.
So you can take a whole hour on Mercado Libre.
Whole hour. We're going to talk about Mercado Libre.
That should be fun.
Yeah. Thank you guys so much for joining us. Have a great day.